Tesla, my Esla, is in the news here today. Everybody's got an opinion on Tesla here today, obviously with the Elon Musk news in relation to finding a new, let's call it Twitter CEO now at this point in time, okay? So two videos I want to react to. This first one's from 2 hours ago. Tesla has a major growth behind it. Hear what Eric Jackson has to say and kind of give my opinions, perspectives on that one. Second video we'll react to in this one, it's a buy one, get two free in this one, is Tesla's real issues are still around demand, says this gentleman from Oppenheimer. So want to watch that, give my opinions and perspectives. And then this one's going to go a little more broad rather than just Tesla. This one's talking about tech market in general and the belief from Chris Toomey that tech is the next domino to fall before the market starts to fall. So yeah, buy one, get two free. Appreciate everybody joining me as always. 26,700. Actually, I think it's 26,800 plus subscribers now. So I appreciate everybody subscribe to the channel. Thanks for being here. Also, if you want to join my Patreon and see the moves I made here today, I actually bought 3 stocks in the Patreon portfolio. Then check out the pinned comment down there. This is supposed to be a sold out tier, and somehow one came, I don't know how this even happened, but somehow one came available, so some lucky dog's going to get in that tier. I don't even know how that happened, but going to have to make sure it's like continues to be sold out. But this is a tier that you actually get access to see the moves I'm making in the portfolio, and you also get access to the Discord chat in there as well. Okay, so I will be pinned comment down there to join us in there. Alrighty, let's get into this.
It's good to see you again. What was your reaction when you heard that he had finally named a CEO for Twitter?
Well, I think it's unquestionably good news, Scott, for Tesla shareholders. This stock is off about $40 since the beginning of April on all the concerns that you mentioned. And I just think it gives the opportunity for people to reassess Tesla, to say he's obviously going to have more time to focus, not as distracted from Twitter. And the great thing that Tesla has going for it is it's you know, we can talk about gross margins and what they will be for the year, but the number of deliveries this year are going to be significantly higher than last year. And if we've learned anything this week, especially with the Disney results.
Before we go any further here, okay, what does the stock price move today tell me? Okay, this needs to tell you something. It's telling a story. The stock price move here today is telling me that all along, Wall Street actually really never cared. They really never cared about Elon Musk being the CEO of Twitter and Tesla. So many people thought the sell-off at the end of last year was because he's now going to be the Twitter CEO for a certain amount of time, right? There was never actually, in my opinion, a real concern in the real reason people sold out of the stock. People sold out of the stock because they believed there were demand issues. They believed margins would go down. There was tax loss harvesting that was certainly going on at the end of 2022. That's why that stock went all the way down to $101 at the lows, right? $101. That's why it actually happened. In today's show, look at, he announces it. What did it do? Nothing for the stock price. If that was an actual concern, the stock price would have been up 5, 10, 15% today. No one was ever actually concerned because the fact is Elon runs a bunch of different companies. He's always got his hands in a bunch of different stuff. There's nothing to do with Tesla's stock price.
Disney Plus. Growth is better than shrinkage. And so Tesla has major growth behind it. I think investors will look at that again now and see that the shares do look attractive between now and the end of the year.
Sure, but I mean, you obviously have to care about margins. You have to care about the number of times they're willing to cut prices to spur demand, no?
I think for Tesla, there's really two battles where it's waging war. One is in China, and one is the rest of the world. In China, they're in a dogfight. There's no question, and so you can make the case that those pricing cuts are coming from having to keep up with the competition over there. On the other hand, though, look at Li Auto's results this week. China is a growing market. It's a booming market for EVs. So they should make money in China. The rest of the world, though, Tesla's really in the catbird seat. And so I don't think that the price cuts are coming from weakness, but rather strength. And they still have a lot of profit margin to kind of work with when making those cuts. And it puts others like GMs and Fords of the world, in a much more difficult place to compete with them.
What do you make?
From strength in respect of, I understand his comment there, but the issue is obviously if demand was overwhelmingly great right now, Tesla wouldn't be have cut prices substantially, right, this year. The reason they did that, obviously, is because we're in a weaker demand environment. It's coming from strength and respect of, like, them versus other competition. That's great, but at the end of the day, like, we know, obviously, it's a softer demand environment for anything high-ticket, homes, furniture, cars, things like that.
The market reaction here. Obviously, when the news broke, and we did it yesterday in closing bell, the stock had popped, and perhaps for obvious reasons. And then it was up slightly again this morning, and then it's given it all back. What do you think's up with that?
I mean, I just put it down to the NASDAQ's down today. Tesla, compared to a lot of names today, is actually outperforming. I think it's still a good news is good news story. Let's see how it does next week into next week. But I do think that this is definitely positive news. Some people are saying, he's not going to be able to give up controls. He's going to be in the hair of the new CEO. But I would point to Gwen Shotwell at SpaceX, who really runs SpaceX there as president and COO. Elon's involved in SpaceX, obviously, but he sort of lets Gwen kind of run the show. So I don't see any reason why that won't happen here at Twitter too.
Yeah, just question is, does Elon just love Twitter so much that he just wants to keep in it, constantly? We'll see. All right, Tesla's real issue is still around demand. This is obviously going to be a bearish perspective, and I love to react to some bearish perspectives as well.
Tesla, what is it? Colin Rush is here to tell us. He's managing director and senior analyst with Oppenheimer. Colin, you surprised the stock isn't holding its gains today?
Not really. I mean, the truth of the matter is that Tesla continues to have an important technology lead in the EV space. A lot of their competitors are really struggling on production and cost reduction. And so
when you see an analyst has a market perform, what that essentially means is he believes that the stock is going to perform whatever the market performs. So if S&P 500 goes up 8%, Tesla stock's going to go up roughly 8% or down 8% or whatever, right? So it's basically going to keep, if he had an outperform, then basically he believes that the stock is going to do better than the market. If he had an underperform, basically he expects the stock to do worse than the stock market in general is doing.
We look at Elon's attention span and the depth of management at Tesla. This isn't a huge change to see him resigning from the CEO position at Twitter. The team at Tesla is a deep, very talented team, and it's very focused. Certainly he's going to have his hands full on the technology side at Twitter for sure. But right. I think the real issue for Tesla now is around demand. And I think the thing that may happen here with the Twitter change is really a repair of the Tesla brand with a certain segment of society.
So that is a really fascinating point. And people have talked about how much Tesla has fallen as a result of everything Musk has done on Twitter and his comments there. Do you think he is reacting to that by bringing in someone who's extremely professional, moving it in more of an ad-friendly way, which has to negate some of the more problematic speech that was viewed as hurting his reputation? So do you think that's partly what this is about? And again, if that's all what's going on here, you'd think Tesla could at least stay positive for a session.
I think it's probably part of what's going on here. I mean, I think the big issue for Twitter is around revenue. We're certainly not covering that company as a private company, but the cash flow is the real concern for Tesla investors for sure, as they look at Elon, selling more of his stake potentially, which does not appear to be a need at this point. So for us with Tesla, it's really a larger picture around what's going on in the competitive landscape, but also the broader macro environment for vehicle sales and EV adoption. Certainly with what we've seen year to date, it's been actually pretty positive, especially for Tesla. They've had healthy numbers in terms of sell-through. We're seeing a bunch of their competitors falter as they go through initial ramps for some of the startups, and even some of the established OEMs struggling with software and other issues. And so the setup for Tesla is good, and the question is around what the margin profile looks like, and that's very much in flux. They have enough granular data to be able to change prices on a regular basis by geography, and we're watching that play out in the media.
Okay, so Colin, that's perfect.
Something I haven't heard of being talked about in regards to this Twitter situation, okay? And I think this matters because I think there's a real potential here, folks, that Twitter is going to go public again. So what I believe it could be a little master plan Musk has here, okay, is first he's like, well, let me start this turnaround process and make all the hard decisions here. So that's what he's obviously done with Twitter over the past, let's say, 6 to 9 months or so, roughly, okay? So he came in, did all that. So he's kind of like bottoming out the business, in my opinion. Now this new CEO gets to come in and hopefully have the business kind of be on the upward trajectory, especially in regards to the financial statements and the revenue and the profitability and those sorts of things, right? So this new CEO comes in and does that over the next 1 to 2 years. And then what I believe is going to happen is I believe Elon is going to take the company back public again. And maybe they'll be called X company or something like that, or maybe they'll still call it Twitter. We'll see what happens. But I believe then he could take it back public maybe in 2024, 2025. At that time, they could be showing revenues increasing again. Maybe the company's gotten close to profitability again then at that point in time, or maybe they're already profitable, something like that. And boom, he takes it public again, cashes out billions and billions of dollars of stock when he takes it public, right? Sells a bunch of shares and then goes ahead and has that money to maybe fund new projects or buy back Tesla stock, or who knows what he would do with the money. But I'm not convinced that Twitter is going to be a private company forever. I think there's a decent probability he could actually take the company public again in 1 to 2 years.
That's the question I want to ask. In the couple of minutes that we have left here, can you take us through, as an analyst, how influential Tesla is with regard to setting prices in the auto market, not just for EVs, but possibly the auto industry writ large?
Yeah, I think it's critical. From a functionality perspective, we're really watching this next rollout of the self-driving technology to look at how they position that, how the technology works, and what the pricing model ultimately looks like. The message that they put out in the last quarter was that they were out looking for users, right? They were out getting customers to buy the vehicles that they could then upgrade through services and other revenue streams. I think what we're watching to see is how that plays out here. We certainly see them with a cost advantage in a number of geographies where they're actually generating cash. They're at a sustainable growth pace. And what this looks like from a margin perspective, both at the vehicle level, but then at the add-on level, is critical to what the valuation is on the stock. And I think it's TBD, to be honest. And that's what we're watching for here over the next several months.
Yeah, fair play. I don't really have any extra comments on that one there, okay? Tech could be the next domino to fall before the market. Let's hear what they say in regards to this one.
One of the highest rated private wealth advisory teams in the country at Morgan Stanley. He's Chris Toomey, and he's back here at Post 9. So it's priced for perfection now?
Yeah, I would say almost the whole market is right now. I think everyone got excited about what was happening with earnings, but this was the whole Wall Street game going into the year. Expectations were earnings going down 4%. April 6th, earnings were expected to go down 16%, right? And so if we're down 8%, that looks like a beat, when in reality, the trend still is very negative.
Sure, but if the trend isn't as negative as some were calling for, that's a whole different ballgame, potentially.
Right, but then you also have to look at what the market's priced for right now, right? So if you look at the price of the market right now, it's over 18 times in a situation where we now officially are going into an earnings recession, and there is a 50-50 chance, depending on which way you look, as to whether or not we're going into an actual economic recession. So in that environment, do you really want to put an 18 times multiple on the market? Probably not.
Well, maybe
something this gentleman's missing here, and this matters in a significant way, is you're going to see a massive acceleration in many of the biggest companies in the market's profitability in the back half of this year. I don't know, I wouldn't say Apple and Microsoft would fit that, but Amazon's going to fit that criteria after all those employee cuts. Oh my gosh, what you're going to see happen with Amazon's profitability in 2Q and then especially 3Q, 4Q is you're going to see, in my opinion, exponential ramp. Okay, we're seeing in obviously PayPal now at this point in time. They just started this. I mean, look at their revenues were up like 10%, and look at their EPS was up something like 60% roughly year over year. When you look at it from that standpoint, this is something that's going to happen. Meta, oh my gosh, do you know what's going to happen? Meta is going to be reporting 30, 40, 50% net income numbers up over the next few quarters, EPS numbers up over the next few quarters, and those are stocks that obviously matter significantly to the market, right? So Apple, Microsoft, you can say, yeah, those ones are priced really rich and they might not have the most exciting numbers, but some of these other stocks that are kind of that next tier down, you're going to see a massive, epic kind of ramp up in their EPS and their net income, and so that's something that I think is very, very overlooked right now in the market and honestly shouldn't be.
Maybe you're willing to put a higher multiple on the most mega of mega cap tech names because you still want to go for quality. If you have to be invested, you still want to go for quality, right? Still want to go where the money is, and you still want to play a little defense. And if you can do all three in that space, why not?
Well, why not is because if we are going into an economic recession, you're going to have a problem, right? So, I mean, if we remember the story, the beginning of the year, economic data is looking better, inflation's coming down, we have no landing or soft landing, and so equally weighted, the S&P 500 looked really good, Then we had this whole situation where the data started turning, and then the banks really had a problem, and you saw that 2-year crash, right? And then all of a sudden, when rates are crashing, you also get the sense that long duration assets are going to do well. So you had people running into tech, which I could say is that sequential next domino with regards to the market falling out.
The market doesn't fall out, though, unless big tech falls out.
Big tech has
right?
to come down. It can't, because it's such a huge component to the underlying economy.
I'm just wondering what makes you think that it's going to, with all of the... Now, granted, it may be overhyped in terms of AI. However, maybe that's the game changer that some suggest that it is, and you're just getting started with some of these stocks, even ones that have doubled, like Meta, for example. There was a positive note from one firm out today suggesting this is just the beginning, this turn.
Right, but I think the thing is I
agree with that in regards to Meta. I 100% agree with that.
The technology industry is immune from the overall economy, right? And I think if you talk about what's being priced into the market right now, what's being priced into the market are 4 rate hikes and 200 basis points of cuts, right? And so I think you've got door number 1 and door number 2, and both are not good options, right? Door number 1, we have those rate cuts. The reason for those rate cuts is that there is clear confirmation with regards to the fact that the economy...
I see the problem here, okay? Here's the problem. We have a market that has gotten so used to grouping everything together. Oh, all these stocks go up together, all these stocks go down together. It's a market. And we have a diverging market now at this point in time. We have certain stocks right now in the market that are 52-week highs. We got a lot of stocks that are 52-week lows, and we got a lot of stocks in no man's land in this market, okay? We're now back into a stock pickers market, meaning certain stocks are going to do tremendously well over this next 12 to 18 months. Certain stocks are going to do bad, okay? There's a big difference between a Meta that has an extremely exciting story for this next 12 to 18 months and an Apple that has a scary story about can they even grow iPhones over this next 12 to 18 months and a rich valuation on the stock right now, okay? There's a big difference. There's a big difference between an NVIDIA, let's say, for instance, and let's say an Intel, right, where NVIDIA is selling these AI chips that are going for $10,000, $20,000, $30,000 for one flip and flapjacking chip, and they have this overwhelming demand. There's a big difference between, let's say, a Shopify that has this tremendous opportunity of them just cutting expenses in a pretty epic way, and what that's going to do for their business model over this next several years, and what you're going to see happen with that company and their EPS and their net income versus, let's say, a Microsoft that, you know, Microsoft's a great company, put up very good, stable numbers, but it's not going to be the most exciting story in terms of net income growth and those sorts of things, right? So we have a diverging market here, folks, a very diverging market between stocks that are going to do okay, stocks that are going to do tremendously well, and stocks that are going to do bad. And these sorts of folks want to just group it all together, and it's like, you can't do that now. You can't group all these things. It's the price action's clear. The price action is clear in the market between stocks that are doing horrible and stocks that are actually doing great.
Is really in a recession, and we need those rate cuts, right? That's door number 1. Door number 2 is we don't get those rate cuts. The market's pricing them, and the market's going to have to come down and reevaluate the fact that we didn't get that 200 basis points of cuts. And then taking a look at that scenario, you go back to your friend Professor Siegel, who is now demanding that we get those rate cuts. Otherwise, we're going to see a really messy market.
Let me ask you this question, because some people have suggested this, that rate cuts, now I know you say, well, they're only going to cut rates if we're falling apart. Rate cuts are always bullish. Tell me why they're not. Tell me why they're not. Well, I'm not talking about in the first, 5 minutes or the first 5 days. Tell me why they're not.
Well, typically, if the yield curve is inverted, the economy is going down, typically that means that we're cutting rates for a very specific reason. We're not in a situation where we're in this economy that's growing rapidly, which is a situation where we actually have to cut rates in order to keep the economy going. This is a situation where we are turning lower, and we need these rate cuts to keep the economy from really going much lower. So in my mind, I think the thing is we need something that's going to preempt those rate cuts, and that preemption is going to be negative for earnings and pull down stock values.
Sure, but I mean, ultimately, like, 08, 09, when the Fed starts cutting rates, obviously the environment's still pretty bad. Ultimately, it ends up being one of the greatest bull markets in the history of bull markets, if not the best ever.
But after the shakeout, right?
Yeah, good point. It was after the shakeout. And I think that's what we got to remember there. You had a kind of 12-month span roughly of viciousness after they start cutting rates. So do keep that in mind. I appreciate everybody joining me as always. If you want to say hello to me, you enjoy the content, say hello to me on IG. There it is right there. And also if you're trying to join my Patreon, there'll be pinned comment down there. Much love as always, and have a great day.